Bank Indonesia has kept its benchmark rate at 5.75% in line with a regional pause as global rates peak. With shifting capital flows and rising geopolitical risk, how should markets respond? DBS Indonesia's Puneet Punj joins us to explain this. So Puneet, how is the current interest rate cycle affecting capital flows and client demand in emerging markets?
See that most of the other global economies are actually in a rate cutting cycle. And you move to Asia, you see that most of the major economies are actually adopting a rate reduction mode as concerns over inflation, spikes from Trump tariffs have kind of subsided. And also now the focus is on the slowing economic growth. So we're clearly seeing the capital flows are back into Asia, both in the bonds and equity markets across Asia. In Indonesia, again, we've seen good flows into the bond markets. The equity markets, I feel, it'd be a little bit of a catch up to do. But clearly, I mean, all of this reflects that there is a lot of investor confidence in Asia. In fact, if you also look at the Asia dollar index on Bloomberg, that itself has actually gone up from 89 to 93 levels in the last couple of months. Again, clearly signals that the balance of payment for most Asian currencies are on an improving trend.
Now that we've identified this, what would you say should be the top priorities in managing market and geopolitical risks?
I think the most important thing is the impact on supply chains and their eventual impact to that particular country. Like, let's say, if in case of Indonesia, I'd say if you're looking at crude, Indonesia is a net importer. And any disruptions, let's say, in the Strait of Hormuz would have impact on supply chains and eventually, pushes up prices and have knock-on effects on various industries. So those need to be assessed. Likewise, I mean, similarly on the macroeconomic front, if you look at Indonesia, again, our core and headline inflation are well anchored. But you have to watch what happens on the US front with regards to the rate cuts. Any delays over there will have an impact on the dollar index. And then that impact will then have to be assessed from what the impact is going to be on dollar rupiah or BI policy rate decisions. I mean, if you look at it from a bank's point of view, I mean, from my trading point of view, trading books point of view, then we have to ensure that we, in such kind of markets, are well within our approved risk limits. We don't breach those. If you're seeing some wild swings in certain asset classes, then we have to ensure that, we trim our exposures, be it like, reducing our PVO1 positions, deltas, etc. So we do look at how we can reduce these by reducing the duration or notional of our outstanding trades. But other than that, we could also kind of move from directional trades to probably more of basis trades, relative value trades to kind of manage huge exposures. So just to give you an example, like rather than, just play on a directional view on Indo GBs or dollar Indons, we could actually focus on reducing the duration there and then probably play between the credit spread between US Treasuries and dollar Indons. We do see opportunities that clients can actually do asset swaps to enjoy higher yields wherever they're seeing, the swap points, tear away from the money market rates. And a similar approach could be used even on the financing front, where you could actually use swap implied financing to avail cheaper financing compared to a straight financing in a particular currency.
And a lot of markets are turning into technology and data in response to this. With that, can you also explain how these help improve trading efficiency and better serve clients?
You can see that these days a lot of banks are actually focusing on offering digital solutions to clients so that they can self-serve themselves, whether it's on treasury products or on other products. DBS itself, I mean, we also have quite a lot of digital solutions out to our clients on the treasury side, both for foreign exchange and fixed income. We offer self-execution to our clients through applications like DigiBank for our consumer banking clients, and through a system called Ideal for our corporate banking clients. These systems basically allow the clients to price and execute their transactions, on a real-time basis, and these deals actually STP into our trading system. So managing risks can happen on a timely basis. As I said earlier, I think accessibility and affordability is the most important thing. So, uh, and digital solutions kind of allow that. Uh, it also kind of helps in meeting most many governments' initiatives on financial inclusion front. So, I mean, again, I want to give an example of DBS in Indonesia. We allow our consumer banking clients to purchase Indonesia government bonds for as little as IDR 1 million. That's equivalent to 70 US dollars. So through our digibank application. So that's the power of digital and how we can actually kind of tokenize the amount to a very small notional, which then allows participation of even small retail investors to buy bonds. Lastly, I would like to highlight that APIs are another way application programming interface, which allows uh, two institution systems to speak to each other. These have become quite popular in banking, and DBS has over 500 APIs across cash, trade, foreign exchange, and fixed income. So these allow our clients to directly connect our pricing systems directly to their treasury management software or ERP for their internal risk management. And also, if they want to offer some of these products to their end clients, so it could be B2B2B or B2B2C.
Thank you so much for the detailed explanations, Puneet. Looking forward to having you back on the program.
Thank you. Thanks. Really enjoyed being part of this conversation.
Once again, that was Puneet Punj, Managing Director and Indonesia Country Head for Global Financial Markets at DBS Indonesia. For more news, visit asianbankingandfinance.net.